how do you start? How do you grow? And how do you be intentional? Because I also feel like in finance, in mortgage, like we were just talking about, I think people need to slow down thought when they're and not be emotional and not make decisions based on emotion in finance, especially because if you make a mistake, it can set you backwards quite a bit. And then trying to figure out and navigate back to where you were. And if you just simply plan a little bit better, you're going to have a better experience, right? And you're going to have a better loan 100%. So that's what I believe.
For sure.
Yeah, absolutely. I think as well, like, and that's part of why we wanted to bring you and hopefully a lot of other people onto the podcast eventually, is to get like your story and kind of your beliefs and systems for how you have grown yourself, how you've grown, whether it's your business or whatever you're doing, how have you made it bigger, better? And how can we apply that to any business or any principle?
Mm-hmm.
So,
yeah. Okay. I think that would be good.
but I really liked what you said about taking the emotion out of it. Like, I think especially in a very like big family business like we have, where there's big families and there's a lot of family involved, you can run into a lot of hurdles on the emotional level.
Mm-hmm.
And you really have to be able to separate the business from the emotions and from the family. And one thing that Jenna, my wife, her dad has run a couple of family businesses, and one of them was cabinet making. He hasn't gone into the full story, but the cabinet making business isn't there anymore. Custom cabinets, him and his brothers. It's not there anymore, and that caused some heartache in the family. And one thing that he said and was kind of advice that he gave to us was, any family party, any family reunion, it didn't matter to me. We still showed up. And he's like, and that's what matters. Show up.
Yeah.
And leave anything else, business, whatever, outside, because at the end of the day, that family reunion matters a lot more.
Sure.
And that doesn't go away. I mean, when I got into mortgages with you, it was very much a Roberts family business.
Yeah, Roberts and Ruger.
Roberts and Ruger, yeah. Mm-hmm. There was a lot of family involved in that. And it was from an outsider, from, not being a Ruger or a Roberts. Mm-hmm. It was interesting to see those dynamics, just as one of the employees there. Yeah. I was a little closer to the family dynamic than a lot of the other employees, but it definitely plays out. I mean, there were epic battles between Scott, Tim's brother, and Scott. Like, literally, there were holes in the wall in the office where they would fight and wrestle. And Tim's a big guy, and his brother Scott's even bigger.
Yep.
And it was kind of it was a little uncomfortable to watch. So, like, these two 35, 40-year-old grown men, big men, wrestling and throwing each other against the wall, and their mom standing there saying, "Oh, boys, stop it!"
Yeah, my mom used to work there as well, and so like one of the other loan officers would go tell my mom to come get us, and
they would tell on you. They'd rat you out.
Oh, heck yeah! Yep. They would do that.
I mean, it was all in fun. They were laughing mostly when they were doing it, but destroying furniture and things at the same time.
Oh, yeah.
Okay, hold on just for a second here, because I have a question about that. But really quick, welcome to the Cutler Cookie Co. podcast. I'm Joe Cutler. We're here with my dad, Jim Cutler, and Tim Roberts, lifelong friend of ours, especially my dad's. He lived across the street from me growing up. Great guy. We're excited to have him on. We're just talking about some wrestling matches within the home loan business, the mortgage business.
Yeah.
I feel like I knew your mom worked there. What, was she another loan officer, or what was she doing there?
She basically was our receptionist.
Receptionist. Okay.
Yep.
Okay. And also just to make sure that you guys
and
didn't
mediator.
put too many holes in the walls.
Yep.
Oh man.
So
I'm sorry I cut you off. I feel like you were about to say something probably really funny or intelligent.
No, I think what you were just talking about, family-owned businesses, that's sometimes how businesses start. It's brothers, it's parents and children, things like that. And we were talking about the dynamics of, family is the most important piece of it. And, I had to learn that a little bit because my brother, like, I'm constant. I'm 24/7. I enjoy my work. I love talking about it. I love thinking about it. But we would go to those family events, be a dinner at my mom's house, and I would be wanting to talk about a deal, or I would want to be talking about like efficiencies and things like that. And my brother just one day he's like, stop. Just stop. Like, this is family getting together, you're breaking bread, enjoying family. We're not at work. Like, talk to me at 8 a.m. and we can discuss your idea or what you're trying to accomplish. So,
which was a big thing too, because not only did you and Scott work there, but your mom worked there, and Scott's wife worked there as well.
yep.
I mean, it was very much, even as a family gathering, it was still, the whole crew's here. Let's talk about business.
Yeah, there were 3 owners, and everybody had a sibling, a parent, a cousin that worked in the business. And then, of course, you came on, and you're my best friend. So, that was another link to just more depth,
Extending that
more layers.
dynamic.
Yeah, extending the kind of the family
Yeah.
dynamics of the business. So,
Yeah. Which is an interesting story. I mean, Joseph talked about one of the reasons we wanted to do this podcast is we get on social media posts a lot of questions about how do you guys do this? What made you decide to use that piece of equipment? I think, and us ourselves, we're very interested in learning how other businesses have built their business and the dynamics and the history of it. And we were talking about your brother's family business, and it was a mortgage company. It was Loanology.
yep.
And that was when I first got into the business. You kind of invited me into that.
Mm-hmm.
And it was at a time when I actually literally was burned out from working in a family business, and I was looking for something different. I needed a change of pace. And I mentioned to you, I'm like, hey, I think I'm going to get my MLO license.
Mm-hmm.
And you're like, oh, you need to come and work with me.
Yep.
Like, of course I would come and work with you. Nobody better to train me.
You got your MLO license, and you were kind of dabbling in it with another company, and then they would tell you that can't be done, and then we would be talking across the street, and you'd be over at my house or I'd be over at your house, and you'd be telling me about a loan scenario, and I'm like, no, that could be done. And then you would bring me the deal, and we would get it closed. We did that 3 or 4 times, and then I said, well, why don't you just come work with me?
Yeah. Turns out the first company I worked for was pretty shady.
Oh, all right.
The the owner skipped town. I showed up into the office one day, and there was a note posted on the door from the state.
Nice.
and he was gone, and nobody got their paychecks, and it was a big mess.
Yeah.
Those sleazy loan officers.
Yeah,
man, I tell you what.
But actually, it was really fortunate that I knew Tim, because he's not one of the sleazy mortgage.
Yeah,
loan
there's a
officers.
right way and a
He's
wrong
an
way,
upstanding
right?
guy and does things the right way.
Yeah.
What would from somebody who like doesn't really know anything about the home loan industry, what would be like a blanket wrong way and a blanket right way, like really easily summed up? Or
I think basically mortgage is about relationships, and then it's also about doing the right thing for the person, not for the loan officer, not for the paycheck, right? Like,
Sure.
I've had customers that have wanted to refinance, and it's just not been the right time, and then like a loan officer needs that loan to like feed their family, but like I would look at the deal and say, it's not the right time. Let me show you why. Right. And then we would explain it and then say, let's target this, and then it'll make sense. Or, you know, a 30-year loan versus a 20-year loan. Why? Like I had a customer that spent a whole bunch of money getting into their 30-year loan, and they were chasing rate. Anytime you're chasing rate, that's the wrong reason to do a mortgage, right? There's got to be a bigger, better reason.
It's like some people have that rate as like a badge of honor. They get
chasing rate would be like trying to find the lower rate, or trying to lock in right at the or maybe juggling or
that's
playing
kinda,
different lenders, I guess.
No, that's kind of timing. Like, you should maximize your rate when you're going to refinance. You should know what's out there. But what I'm saying is, if we're just at a 6% rate and we're just trying to get to a 5% rate, and that's the only thing that we're visually looking at, that's not necessarily the right strategy in lending or refinancing, because you're refinancing back 30 years and reamortizing. That's not cost effective, right? Like, so they look at it and say, well, 6 to 5, I'm paying less interest. But if I'm reamortizing you back to 30, maybe you're not paying less interest. Maybe the play is, maybe you get a little bit lower than 5 and you go to a 20-year term. Now you've benefited yourself, right? Or
over the longer run.
Right.
Yeah.
Or if we create and go to a 30-year amortization, and I create a big $1,000 spread of income, well, what are you going to do with that cash flow? Like, don't go spend it, invest it. Like, those kind of conversations, right? And so I think loan officers just and there's a lot of good loan officers out there.
I would say there's more good than there are bad.
100% agree.
The industry, especially since 2008, I think they really weeded out a lot of the incentives to be a slime ball, and a lot of them are gone.
Yeah,
I think generally it's a pretty legit, upstanding profession.
Yeah, yeah. One of the employees with our company, rates were going down. He came to me and he said, hey, let's refinance to a 30. And I looked at his original loan and I said, like, he bought out mortgage insurance. Like, he spent a ton of money to get into this loan. And he was in that focus. He was like, I want to go to a lower rate and get the lowest payment. So when we ran the numbers, I just told him, no, don't go to a 30. I won't do a 30, but let's do a 20. And we had that conversation. And then once I showed him why the 20 was better for him financially, he was like, yeah, let's do it. And then a year later, because rates kept falling, we went to a 15-year, right? And so there's just intention is all I'm saying. It can't be just chasing a rate, because if you're chasing a rate, it's likely you're not seeing the bigger picture. And so maybe you need to ask your loan officer a few more questions, get a little bit more advice before you make a decision,
Yeah. That I like that. In our last home that me and Jenna purchased, obviously Jim was helping us a lot with that. But then James Hurst was helping us a lot as well. And he brought up that we had a little bit of a range depending on how much money we wanted to buy the rate down, and how much money it would save us over the course of, because regardless of what we got at the time of the origination, we were intending to refinance at some point. And so he kind of laid out a spreadsheet for us and was like, if you buy it down to here, here's how much money you could save over, a 3-year period until you would refinance. And if you buy down to here, here's how much money you could save, and kind of just weighing the pros and cons of how much do you want to pay right now to buy it down if you're intending to refinance in the future. And that was really helpful for us to look at.
Yeah, because if you're buying it down and the farther you buy it down, it's not like to like. It's not like a quarter for a quarter or a half for a half, right? A quarter might get you an eighth to a quarter, but like a point might get you 3/8 better in interest rate. And then you have to look at the cost. My theory is if interest rates are going to fall, you're better off to take the higher interest rate. In fact, maybe even pay less fees and take a higher rate and then refinance in 12 to 18 months. Right? Because if it's going to happen, like, then it's cost effective, and people don't always understand that. Like, why would I want to take a 6.75? Well, it's probably more likely to get to a 5.75 or a 5.5, and that's more cost effective. And there's your time to buy down the rate.
Exactly.
Like if you're gonna refinance. So it's just being, like I said, being intentional when you're making a decision on what to do. So,
and I think it's important too to understand really the role of someone like yourself. That's been doing this for 30 years plus, and just the knowledge that you have in this. Where there are a lot of people, not to call any specific person out, but people, very intelligent people. You get engineers specifically that'll get in there in that negotiation, and understandably, they're smarter than most people in the room.
Sure.
And that carries on to everything. It's like, okay, well, I'm going to be a market expert and determine when I should lock that rate and not listen to my consultant who really is an expert in this one thing. And it's important, I think, for people to understand that, generally your loan officer has your best intention in mind if they've done the job of doing a short consultation to understand what your goals are, which is really a key part of what you do. It's really, where are you at? What are your goals? And we go back to that emotion thing you talked about. In sales, emotion is so important, and salespeople traditionally want to tap into that emotion to get you to make a decision. And it's not that different from our understanding from the training that you and I both did. Emotion is important, but you got to do it with intent.
Right.
Like, so that initial interview is, why are you doing this in the first place? What's your reason for wanting to get into a home or to refinance? What's the real reason? It's not the rate. It never is. There's something behind that. What are you trying to accomplish? And if you can really help them understand what that reason is, then when rates start going around and you're like, hold it, you can come back to remember your reason you want to do this. Let's focus on that. Let me worry about the mechanics of when to do this.
Right.
Is that?
Yeah, I think one of the biggest things that I would tell anybody, share everything with your loan officer, in the mortgage business, in the relationship, just because the more knowledge that they have about you, the better off they are to find the solution that works, right? And minimize the risk of somebody's whether they're going to be approved or whether they're not going to be approved, right? And so I think that you'll get more out of it. And then I also feel like the more that you can establish the relationship and the trust with your loan officer and let them do their job, which is what you're speaking to, anytime a person tries to control the loan, as a buyer or as a borrower, and they're trying to control the loan, they want the best rate, or they're just they don't want to share a document, or they really kind of get in the way of themselves. The problem is that actually makes their experience worse, right? Whereas if you actually ask the questions and create the relationship and let the loan officer work, and like I like to talk a lot about interest rates breathe. They move constantly. There's and it's not like big swings, but there's swings, right? And sometimes if the customer will just like trust the process, and I say wait for the market to breathe, and then when the market breathes, and meaning it pauses and goes down a little bit, and then I say now it's lock. Other people get caught up and say, well, no, I could get another eighth. Well, you're more likely, if you get into that, you get stuck into that trap, you're more likely that the market's volatile, you could lose 3/8 versus pick up an eighth. And so, you hired an expert, a specialist. So let them, and you've decided to move forward, let them get the best deal for you. And like we talked about, there's a ton of good loan officers out there. And so it's just, how do you get referred to them? Ask questions, and then share. And then you'll have a really good experience in buying a house or refinancing.
And I think that's something that you clearly have done a really good job at, is being somebody that people are referred to, and getting yourself out there as somebody that people will call up like, hey, that's a good loan officer, and I'm going to use him. Something that I get asked occasionally when I have told people that, oh yeah, my daddy did home loans for a really long time. He's helping us with our home loans.
Did you say daddy?
No. I said
think
dad.
you did.
Maybe I didn't. Anyway, my dad, he is helping us with our home loan. They'll ask, what is the purpose of using like a home loan specialist, I guess, versus just going to my bank or credit union, because they do home loans and they already, have access to all my accounts and everything. Why would I go to someone like you or you when I could just go to a bank down the street or my credit union?
I think
that's a good question to ask Tim. Honestly, I'm going to interject really quick.
Yeah.
But to be clear, Tim does work for a local bank, right?
Mm-hmm.
So he
A
kind of,
community
in a
bank.
way, he is that scenario with a twist, right?
Mm-hmm.
Whereas, we have a local credit union that is probably the largest bank literally in Utah, but it's a credit union. It has the most people. And a lot of people will ask that question, why wouldn't I go there? They're doing a really good job of advertising rate.
Yeah. There's multiple reasons that I would say do that. But like, I think word of mouth is probably one of the best ways to find a loan officer, or a specialist. Like my wife just recently had surgery on her arm. She has a doctor that she just loves, and whenever she's going through something, that conversation comes up somewhere else, and so then the conversations happen, and she refers her doctor, and I think when you have somebody that's already worked with a loan officer and understands, or works with a specialist, and I'm talking doctors and CPAs and financial planners and like whatever the specialist is, people know that. And if they're going to refer, you refer because you want to help somebody, right?
You've had a good experience. You want them to have it
you have
too.
a good experience, but you're also, your name's on the line when you refer somebody into a person. So like, if you're willing to refer them, that's a pretty good endorsement as to why,
Yeah.
And I think if you just walk into a bank and just select somebody, or you get online and just start the process and don't have a relationship, how do you start answering those questions, or how do you feel comfortable sharing those questions or answers when I ask, and then get the real benefit? There's transactional, like you can be a transactional loan, and like, unfortunately 15% of the world lives in that world. Like they just want the lowest rate, the lowest fees.
Sure.
And there's a good reason for that. But like, if you want high value, high service, and yeah, maybe the interest rate's an eighth more, or the cost is $500 more or something like that, the value you get is you probably get a better loan, and you get a better loan experience. And like, again, I feel like loans have to have purpose beyond just a loan today. Like it is not just today. Like, how we set this loan up affects how you're going to financially run your life for the next 30 years. Right.
Yeah. It's a big deal.
Right. Right. So,
especially for someone like me who, I'm just buying a house to live in.
Right.
Like I'm not going out buying. Both of those are big deals to go out and buy investment properties, but it's a pretty big deal to buy the house you're going to live in. And you want whatever loan you're going to have on that for 30 years generally to be put together nicely.
yeah. So every person's story is different. We were talking about that earlier. Everybody's story is different. Everybody's why is different. Everybody's experience is going to be different. And if you just walk into the door and take the first person, like they're going to do a good job. They wouldn't be hired if they weren't going to do a good job for you. But there's no way to create. It's going to take longer to create the relationship. So somebody else has already created a relationship, understands the process, and finds value in it, and sees the value that you would experience. Maybe knows your story a little bit, and say, you know what, you need to talk to Tim, or you need to talk to
So it sounds
else.
like what you're telling me then is really what you get is a personalized experience that is focused on the buyer instead of just going in and getting an experience that's focused for the company.
Right.
I suppose.
Right.
Okay.
Yeah, in a lot of cases like that, like you were saying, if you can just go online and fill out an application. You don't have a point of contact there. Eventually somebody will receive that application at whatever institution, and you'll get a phone call, and they're going to review kind of whatever documents you've submitted and what documents still need to be submitted. And that's pretty much the depth of the relationship you'll get. It's like you say, transactional.
Yeah, and you might not talk
if something
to
goes
same
sideways,
person.
you don't have somebody really advocating for you on that, which is, I think you taught me early on, we're an advocate for the client. And it's kind of like every loan, even as this cut and dry as it might seem, every loan is like a puzzle, and you've got to figure out how to fit the pieces together to make it work. And it's fun. That's why I loved the business.
Oh yeah,
Still do.
It's a blast.
Well, and I think that's something you've done a great, both of you, but you're less in the loans now and more in the cookies business. But that's something that I could see from the outside, that you did a great job of keeping those relationships going after the loan. And then those people are coming back to you for maybe an investment property or maybe a refinance, or, they just want to move and get a new house or whatever. How have you been able to do that? How have you been able to keep repeat customers? Like, what is your strategy?
I just believe, like I've been thinking about this a lot. We're going into the new year. It's a reflective time. I didn't have the year that I necessarily wanted to have. So I kind of reflect how I like to do my business.
Can I just interject there? Tim says he didn't have the year he wanted to have, but he's still in the top 5% of originators in the country.
Sure.
I mean, he kills it.
Yeah.
Like he missed his goal by $600. So damn, I didn't do what I wanted to do.
Yeah. I missed by a little bit more than that, but I do feel like I'm going to go a little bit farther. I'm a goal-oriented person. So I every year I sit down, I look at my past. I've got a spreadsheet that's 23 years old. I really get into the numbers. I get into the history. I get into the trends. And then I figure my goals backwards, but I use my trends and I use my history to set goals. Right.
Yeah.
I have a philosophy that, I want to create 150 relationships in a year. Like I want to mentally stay focused on that, and I have a database. My dad taught me, 3 years into the business, he actually told me right when I got into the business, get a database. And I didn't listen to him. I had a database in Facebook and on my
Sure.
mobile phone and on an Excel spreadsheet. I had it everywhere. But
So he's like telling you put together your Rolodex, basically.
yeah, get it into a spot. And then I care about my customers. I learn about my customers. Like in those interviews, we don't just talk about the loan. We talk about, one of my favorite things is when we're doing an application and they say, I'm an engineer, software engineer, or I'm a doctor, and I practice this medicine, or I do nails, or I'm in the cookie business. The conversation is, well, how did you get there? Right? Like tell me more about your business. Tell me, why did you pick medicine? Why did you pick software? Where did you go to the university? Like, it's more about building and understanding you, the person. And then once we do that, then really, it's awesome. Like I had a customer that he had bought a house, and he was sharing stories about his life. I was sharing stories back about my life, and we closed the loan. Hadn't talked to him about 3 or 4 years. He calls me back and says, because I keep snail mail out to people and I keep track of them, try to acknowledge their birthdays and things like that. But he called me back, and it was like we never had a 3-year gap. He asked me about my family in like 2 seconds, and he knew my kids' names. I knew his kids' names, and it was such a more pleasant experience. And then after we kind of got through reconnecting, we started talking about loans. And so, and what he was trying to do and things like that, and just different strategies. And I'm all about strategy, and I'm about education. So like, I would rather teach you like why you're going to make a decision that you're going to make, right? I know the loan that I would tell you to do, but I don't know that that's the best way to, and that's what you're going to get when you just go walk into some place, right, and they're just going to say, do this loan, and you're not going to know why.
And they might not even weigh different options for you.
No, they're just
give you the one and say, yep, that's the one, go for
it. I had somebody that was wanted to do a VA loan, and the first loan officer that he talked to, that guy looked at it and said, kicked the VA and just said, no, we're doing a conventional loan, right? And didn't tell him why or anything, but offended the person.
Sure.
So he went to a VA company, right? And so that guy just put him started talking about the VA loan and nothing else. And now the customer has questions and he can't get answers because this guy's just saying VA,
only
VA,
does VA.
VA.
Yeah. Okay.
So then he was referred back by his dad to me. And then I explained both loans. Like, this is why this customer's telling you, or this loan officer's telling you the conventional loan's better. This is why he's saying the VA's better. Doesn't matter what we think is better. Like, it's what fits your needs. And then I'll explain both how they fit your needs and both how maybe they don't fit your needs. And then you ultimately get to make the decision, right? Because you can put 3 or 4 loans together, honestly, and your payments will only be $30 or $40 difference between an FHA, between a conventional, between a Home Possible, between VA, between USDA. It's just moving all the numbers around, and then I'm going to show them to you, and then it's, what's your preference, right? And then we'll talk through it, and I'll explain.
Well, it's not even just what's your preference, but what's your credit profile and what's your portfolio look like, because that can make a difference. I know you want to do this loan. You're not going to do that loan. We can't do it for you. Yeah, I have somebody right now, and the borrower is a great borrower, really good borrower, but the collateral is not, that the house is doesn't meet Fannie and Freddie's guidelines, doesn't meet a conforming loan. So I can't do that loan. And that is what they want.
but we're going to have to do a bridge loan. We're going to have to, we're going to have to do a short-term loan, like this is a 2-year loan. It's a 2-year plan. Let's get you here. And then that's where the value of a loan officer is as well, rather than just walking
Put together
in.
like a game plan.
Yeah, we're creating this loan. We know why we're doing it. This is the thing. These are the like 4 or 5 things you need to do in the next 6 to 12 months.
Okay.
So that we can shift to the better loan.
Right.
Right. And that's just,
Whereas if
helping
they'd gone
somebody.
to just some credit union, they might have just been told, nope, you can't do
it's a
either of
decline.
those, they can't do that loan you want. So see ya.
Yeah.
Okay.
Yeah. And the other benefit that sometimes banks have, like I just did a loan for a gentleman, and like he's a perfect borrower. I mean, in the sense that just it's a high wage earner, has a lot of money in the bank. But he's going through a job change, right? And there's certain rules, specific rules on the job change. Well, honestly, he doesn't qualify. Like he buying a house today, he doesn't qualify. But like in my world, then I can do a portfolio loan, right? We can do a portfolio loan and maybe ask for an exception and make it work, right? Because
Okay.
we can that's the value of maybe going through a community bank but that's very relationship driven. Like you want somebody that, back to what we talked about, an advocate of the person working the deal. So like if that gentleman goes to another lender, it's a decline. And
Yeah.
he doesn't know why.
Just based on the papers,
He
based
or
on the
she,
paperwork
yeah.
that he or she is able to provide.
Mm-hmm.
There's another difference there too, and this is, I hear it advertised often that, come to us because our loan officers don't get paid on commission, and so it's going to be better for you. They're not incentivized to give you the worst deal. And I always think about that. Why would somebody that's paid on only getting that loan completed be a worse deal than somebody who could care not whether your loan closes or not because they get paid either way?
Mm-hmm.
I mean, there is a lot of incentive that is attached to the fact that you only get paid if the loan closes.
Right.
And oftentimes you tell them that's not a good loan for you, don't do it.
Right.
And that's after spending hours and hours with them trying to figure out what their goal is. I don't know if people realize that you just worked pro bono there for them.
Yeah, and I don't mind. I never mind working pro bono. I never mind, and I don't really know that it's pro bono. It's just future business, and it doesn't
building
mean
that relationship
just-
that either
right,
they'll come back to you
right.
and they'll tell their buddies about you, their family, their friends. They'll say, "This guy really put in a lot of work for me, and he's a great guy, and you should talk to him for your home loan."
Yeah, I told one guy, like we were talking about. I told him no, it's not a good time to refi. Showed him why, and the very next day he referred his coworker to me to do a loan, and that person closed, right? And
There you
so
go.
yeah, and so if lenders or loan officers, I think I do think being referred is an important part of it. I think if you are referred, it's good that you should talk to that person. I'm not saying you just have to use that person point blank, like know what's out there in the market, have your conversations and things like that. But once you pick somebody, just make sure it's a good fit, and then just understand that, it's in the loan officer's best interest to help you, and they're going to. Like, there's good loan officers out there.
So, kind of the difference between going to a really sleazy car dealership versus a car dealership that isn't just trying to sell you their lemon.
Yeah. I think I still go know what you're buying.
For sure.
Yeah,
So-
it's a good idea to, maybe interview a few different loan officers before you get into that process. Because I think something you touched on too with that client that called after 3 years and you were just best friends. So, you hadn't talked for 3 years, but you picked right up. I think that's a big difference because, again, you're going to be their advocate. You want to get this done, and you'll see things that you can do that they wouldn't be able to think about to accomplish that. And you're going to be able to, You shared a story with me the other day where somebody didn't want to talk to you. They wanted to go over your head and talk to the underwriter.
Yep.
It's like, you really don't want to talk to the underwriter. Trust me.
No one
They
ever
could care
wants to
less
talk
if
to
your
the
loan gets done. I care.
Yeah.
Let me handle that.
Yep. Yep. She did. And then I texted her and then she said, I said, let's have a conversation. She didn't want to have a conversation. She wanted to talk to my manager. I said, okay, well, let me establish that. But then right behind that, I texted her and said, this is what I was going to say. And she said, yeah, we can have a conversation. So like,
It's like, you know how to communicate with the different underwriters, because there's a lot of different personalities there. The different closers, the funders, there's ways to grease the wheel that if you don't know them, you don't know that personality. Good luck.
yeah, every underwriter underwrites different. They'll say they all underwrite to the exact same way, but they don't. And actually, I'm thankful that they don't, because Joseph, your deal might be different than your dad's deal, right? Might be different than this person's loan. And so like when I'm looking at it, like, and a loan officer, I can't steer. I can't like just go to, just say, well, I'm just going to take this one to that
Right.
person because they're going to do something for me that they're not. They're an underwriter. They do a good job, and I don't even know how they keep track of everything that they keep track of, or how they find stuff
It's
that.
an underappreciated job.
But where the value of an underwriter is a conversation. So like I always, if I get a loan like that's different, then I go to the underwriter that I know has that strength, and then we talk about it, and then I build the loan to that strength, right? Rather than
Sure.
just being unsure and just throwing something against the wall and hoping that it sticks. It's very intentional how we're going to structure the loan, why we're going to structure it this way. And I'm going to explain that, and your loan officer should explain that, and then move the file forward. And then that's when customers they will have a lot better experience. And often the borrower doesn't even know half the stuff that the loan officer's working through to get them the best
Sure.
loan.
So from a home buyer's perspective, or even from your perspective, a family or a person like me, if I'm going to buy my first home, what are the odds that I'm going to be in that home for the full 30-year mortgage? And how does that play into how you design the loan?
I mean, generally most people refi or sell or do something within the first 7 years of a loan, right? We're not, most people aren't idle. Most people don't just lay roots and sit and be happy with what they have. They're always moving forward, or the
Sure.
dynamics of their life change. And so a refinance happens. Somebody has a killer rate and life's good, but then they get divorced and they have to refinance, right? And so so I just think that's the conversation should be have, and that's part of the purpose, right? You're not going to be in that house all the time.
Yeah. Have you ever seen a 30-year mortgage get paid off in full? Like first time home buyer
in 30
stays
years.
in that house for
Haven't-
30 years and pays
Haven't
off
been
the
in the
loan.
business long enough.
I can tell you, I did a search the other day on that, and we can talk about this too. Joseph had another question, but statistically, I wanted to know what percentage of 30-year mortgage originations go through and actually make 360, or is that it? 360 payments
yeah.
and pay it off on schedule.
Yeah.
And the only answers it would give is, well, statistically, most people, the average 30-year mortgages last about 7.5 years.
Right.
I'm like, I don't want to know that. I want to know the number of how many 360 payments. It doesn't exist. There was not a database that has any record of that ever happening.
Yeah.
You can do any search engine, any AI, that number does not exist.
Right. Yeah. I just
They
think
either pay it off early or they sell or they move. Something happens.
life changes. Yeah.
Even if they do stay that and they pay off their 30-year mortgage, they didn't do it over 30 years.
No, they're going to pay off early or do something.
Something's going to change and they're going to make early payments or or upgrade or whatever.
Right.
So that's kind of a lead into one of the questions Joseph was asking.
I was really curious because I was talking about this with Jim a couple weeks ago. And one of my brother-in-laws works for the FDIC. And he loves spreadsheets and stuff. He's all about numbers. There was a lot of talk and a lot of news about a potential 50-year mortgage.
Mm-hmm.
And I was curious what your thoughts on a 50-year mortgage are. And if that's just, listening to the radio from whether you support the current administration or not, that has got to be the dumbest idea and it's screwing over home buyers, period. Stop.
Yeah. I mean, there's talk about 40 years mortgages and 50-year mortgages, and they will go compare against other countries that have different loans and things like that. I just think, I think shorter is better always. Like I heard that article. We had a conversation inside the bank. They were talking about it and they brought it up and I'm like, why? Like, I mean, seriously, why would you even consider a 40-year? I mean, honestly, the payment difference between a 40 and we're talking about a reasonable $400, $500, $600,000 house, right? Those are usually only going to be like 10% of, like, if it's a $600,000 house. If I did a 30 versus a 20, that's probably going to be about $600, right? Difference in payment. So, and if you go to 40 or you go to 50, that's just going to elongate that, make it so that it's weaker. So, I mean, if I go to a 40, it's maybe like half of that. And if you go to a 50,
half of like savings
because
instead of a $600 savings,
mortgage is
from 20 to 30,
front loaded with interest. So who does that benefit? If you go to a 40 or you go to a 50, who does that benefit? That just means the bank is the lender, not really a bank. The lender is earning the lion's share of that payment in interest because you're not paying down principal. Right. And so you should think of it backwards and say, all right, I need to go to 30 should be the max. And you got Dave Ramsey that wants you to go to a 15 or not have a mortgage, right?
Well, Dave Ramsey, you should work 3 or 4 jobs and pay cash for it.
Yeah, I used to think he was psycho, but I don't know. I think he's got some good.
Dave Ramsey would hate me.
Good thoughts, like, right? But
so my thought on that too is, again, considering that you're only going to be there for 7 years, this isn't a long-term loan, literally for anybody, even if they think it is. It's not. So why wouldn't you want to have the lowest possible payment possible during that 7 years that you're going to be in that home? That loan, not the home, the loan, the instrument.
Okay, so in a perfect world, you're going to retire at some point, right? Like, I think, Joe, if you buy your house and you're going to live there 7 years, like, you should make your payments. You should, if you have the ability, overpay even by $100, like,
even if I'm only going to be there 7 years.
Yeah.
Okay.
Even like $50, $100. Like, it doesn't have to be grand. It doesn't have to be a whole bunch. It just a little bit. And I'll tell you why. So then you got the appreciation of your home's growing. You're paying down the principal. Then you should sell your house, right? You should take all your equity and you should apply it back towards the loan and buy a bigger house, more asset, right? And then you should do a 20-year loan, right? And then you should, if you're going to live in it another 7 years or whatever, then play the same game.
What
and then
would be
go
the
to a 15-year
difference? Would you think in the built equity over that 7-year period, with like a $50 a month extra payment towards the principal?
I don't know.
Would that make a drastic difference on, let's say, a $400,000 home over 7 years? When I go to sell versus if I had a 50-year mortgage and was just paying the minimum every month.
Well, if you're paying a 50-year mortgage, you're never going to own the house free and clear. Right. There's just
I'll die before that.
No
happens,
way that I
even.
can get you there.
in that loan.
Right. Yeah. You're going to have to wait for appreciation and make sure that appreciation's there, or you're just not going to, you might as well rent if you're on a 50-year mortgage. But like I did for my, for one of my borrowers, like we did a debt consolidation. And again, I'm big on a plan. So we paid off his car, but I said, okay, these are the two things that I want you to do. Every year, I want you to just pay one extra payment at tax time, one extra payment. And then on the monthly, I said, take $100 from the car we just paid off. He's still cash flowing better, and pay it towards your loan. Well, he got into a bad situation, had to refinance again. He had only been in the loan like 2 years, and he had applied this strategy 2 or 3 years, and he was 3 years ahead on his payoff, on his amortization, just by doing that.
One extra payment a year.
Well, he was paying 2 because I was having him pay 1 per
plus
month, then I was having him pay
a whole extra payment at tax time.
Just because of that $100, just think about it. The extra $100 that you're paying on principal, that's interest that you're not paying on that for the next 29 years, right? Multiply that out, and I'm sure it's double your $100. So like,
if you stayed in it for 29 years,
well, it doesn't matter. It's still making your amortization go forward. Right. And then if you like have that plan, and if we went to a 30, we overpaid just a little bit. We let the appreciation happen. We sell the house. We apply all of it back towards the house. You go to a 20-year, right? Then you do it again. By the time you're 50 or 55, you have your house paid for. And
then you just don't have a home payment at all.
You have 10 years of like either buy a bigger house or maybe you downsize or something, right? And so I just think there's got to be logic behind it. And I think if we move into a 40 or a 50-year mortgage, which I don't think will happen, I just don't think legislation will let it go, because I don't think it helps the customer as much as our government would say it was. That doesn't fix the affordability problem.
Yeah.
Right.
Well, and like you were saying, it really doesn't make that much of a difference monthly wise. Like if you're just looking at it from a payment standpoint.
Mm-hmm. Yeah. You're just elongating it and making it. I just think that there's better ways. And so like I would, if it was me, my first time buying, I would buy a house, then I would.
So there's two things at play there. I mean, you're putting extra money into your principal, which is different than paying your full payment. The majority of it goes to interest. Mm-hmm. So by paying that one extra payment a year, that full extra payment goes to principal.
Yeah.
None of it goes to interest.
And you're not paying 30 years of interest on that payment. So you're avoiding paying interest on it. You're not. That's another thing, though, is any extra money you put into your house, you're never earning interest in that. Your house will appreciate or not, regardless of how much money you put into it. So it's essentially sticking that money in the bricks of your home. Mm-hmm. It's not an appreciating vehicle. Like when you put extra money into your home, you're just decreasing the amount of interest that you're paying by doing that. Yeah.
So one of the arguments is, well, couldn't you take that money and put it in Tesla stock or, something that's going to appreciate? Yeah, sure. You sure could.
Yeah.
And if you're disciplined enough, maybe so. Maybe you should.
Mm-hmm. Yeah. I mean, I don't know. Everybody's different. That's the whole conversation you need to have with your loan officer, right? Like, what is your risk tolerance? Do you want to put it in the market? Like,
and how disciplined are you historically?
The other plan is like, you buy a house, you live in it 7 years. We go through a really big appreciation like we did in 2020 and 2021.
Right.
You sell that house. Well, how about you buy 2? right? You buy a house to live in because you have a bunch of equity. So you buy a house to live in, and then you buy an investment property. Now you create cash flow. Now you create wealth, right? You're growing wealth with real estate. That's a plan, right? It can be your plan. And so it's just, I just think that there has to be a lot more thought and intention. Slow the process down. I like slowing it down and having conversations before we accelerate. And once we know what the plan is and everything, then we accelerate. We go for whatever loan or whatever we're going to do.
I think that's been an important thing that we've tried to apply here, that we realized is we really had to spend a lot more time on the front end to get systems in place so that, it's morning right now. We have a crew in there baking cookies and frosting them, packing cookie dough pints, making dough, making frosting. Previously, making a dough or making frosting, there were only like 2 people that knew how to do it, knew how to operate the equipment. These 2 people. But now we can sit at this table and have a fun conversation with you while we have people that can follow the system that we spent extra time to build so that they can follow that. And yeah, I feel once you have kind of your game plan, that's when you can hit the gas pedal and really move on it. And I feel like that's kind of what we've been trying to do here now is we have our game plan in place. We've built a lot of systems, and now we can hit the gas pedal on trying to replicate that system in more places.
Mm-hmm. Yeah.
It's interesting too, because it's a family business. It's been, 45 years in the making. We literally get people like not monthly, but fairly frequently that will reach out and say, "Hey, will you franchise this? Will you open a location up here or there? And we really want to franchise your location." And to Joseph's point, that's not part of our goal. That's not part of our plan right now. We're focusing on systems and building a foundation that we would allow us to then make those kind of decisions. And part of that is, we want to open our own locations and prove the concept outside of this one location before we even explore those options. Last thing we want to do is sell a franchise to somebody with no systems and really just setting them up for failure. And there's story after story after story of successful businesses that start up, and after the first year, they're like, "Yeah, let's franchise."
Yeah.
And it just flames after 3 to 5 years because there's no framework set up to do that.
Yeah, I mean, you look at your systems, you've built your systems, but we don't just set our systems. Like I'm in this mode right now as well. I'm looking at my systems backwards and then saying, how can I tweak my systems to go forward, right? Like I love books, and I love business books. I love psychology, E-Myth, right? E-Myth Revisited. That's a really good book about systems and, growing a business. Like you are when you start a business, you're the bookkeeper, you're the president, you're the janitor, you're everything, right? And then you build your systems, and then you move yourself up, and you hire a couple people to be that person to help you. And then it morphs into a bigger business and a bigger business and a bigger business. And Jim and I talk about books all the time. Like I read, what is it? Checklist Manifesto. Like you would think that's the most boring book in the whole world, but it's such a cool book because it teaches you, it's being told through the filter of a physician, and he's telling you how he adapted checklists to his business, but he's also reflecting how the airlines uses checklists, how big project managers that build skyscrapers, how they use how they use checklists and everything like that. And it's like checklists are
if you follow a checklist strictly, you're not going to miss
right
some structural foundation. Maybe if you're building a skyscraper, or you'll remember to sew the person up after surgery.
Well, they were
Remember to remove tools before you sew them up.
tools.
yeah.
Right. So I really like different books, and that should be another podcast someday. We'll just talk about
Yeah.
books and like,
That'd be, yeah.
you know, things that I would tell you to read. Another book that's really interesting is what is it? I'm trying to think now. Oh man, I can't think of it.
It's funny when we have these conversations. It always reminds me, even working with Tim, I'd come home and tell Connie Sue that like her and Tim, Connie Sue is my wife, they're the exact same personality in the way that a checklist book, I want to read that one. Spreadsheets, bring it on. I love that.
Yeah, unreasonable hospitality.
Unreasonable
yeah.
hospitality.
Yeah.
I feel like I've heard of that one.
Yeah. So that's from
I'll add it to the list.
That's through the author is built restaurants, and so it's all through his filter of, you know, building a business through restaurants and then customer service, and it's just unreasonable customer service. Like it's like takes it to the nth level, and but you can learn so much from that book. You can learn so much from Checklist Manifesto, from E-Myth Revisited. Like if you really want to build businesses, I would tell you like get into reading books, reading different books, and
seeing how other people have done it.
yeah, like I really value reading a book from somebody who's different perspective. Like he's a entrepreneur, whatever. What are they?
I like that, restaurantrepreneur.
Yeah,
That's a
it's
good
not
one.
really a word, but
It
It's
should
a great
be.
word.
right. But yeah, how he
Yeah. Made his business work for him.
right.
And
It is good. Yeah, you shared that one with me, and Connie Sue and I have both been reading that.
Yeah,
Haven't finished it yet, but it is. I mean, it's sort of our industry, but it's more of the the Michelin star restaurants, where every little detail of the customer experience is focused on, and it's a fun. We talk about that a lot. In fact, when we first bought this business, we had some real conversations about that. It really has to be focused on that customer experience. And
well, I think any business should be about your customer, right? It should always be about the customer, not about the business. And
yeah,
I mean, we all want to be profitable. We all want to make money. But honestly, my forward thought has always been, if I take care of my customer, then everything else will be fine. Like I've had customers where they've come to me and said, I'm not going to buy a house. I'm like, okay. But let's go through your questions and let me answer them. And let's not even do an application. Let's just let's teach you. And then they do an application, and then, I get the approval done. And then they're like, I'm not going to buy a house. I had somebody literally, she's kept saying that, I'm not going to buy a house. How are you going to get paid? I said, don't worry about it. Let's just walk through it. And then she kept it up. And I finally said, I stopped and just said, after the third time, I said, do you ever think you're going to buy a house in your lifetime? And she said, yes. I said, great.
worth it. Then.
Worth it. Let's talk. And so we
Heck
went
yeah.
through it, and then,
not only that, but do you know anybody else that's going to buy a house? Let's keep talking.
I think there's a lot of value to that, though. Like being able to ask someone like you questions about buying a house. Maybe I might feel like, oh, I don't make enough money probably to buy a house, or I'm better off renting for now, or yada yada yada. But it can be a confusing process to put a loan together, which is why there are people like you.
Mm-hmm.
And so to be able to approach someone like you who's willing to do that work, even if maybe you're not ready to buy a house, and that can shed a lot of light on what you could afford if you did decide you wanted to buy a house, or how, where you're at right now and how much longer is it going to be until, how much do I need to save? How much more do I need to make? Yada, yada, yada. What things need to fall into place in order for me to be able to buy a house. And that's where someone like you is just incredible at that.
Yeah. How long do they need to stay on their job? What if they make a job change? Am I self-employed? If I make a switch to self-employed, if I'm commission based, like there's all these like nuances to your income, and those all change the dynamics of the way that we're going to structure a loan or when you can buy, right? And so that's where the value of talking to your specialist, your loan officer, just like if you go in and talk to your doctor or whatever, your CPA, you need to have those conversations, and they need to be deeper than just a transaction, because that's not where a loan officer is valuable to you, is if it's just a transaction. If it is, anybody can do that loan, then
Sure.
but you won't get the benefit of it. I've had investors that only make like $2,500 a month, but they had, their consumer debt was in check. They had done really good job in saving money, but they bought over a short period of time, over like 3 years, they bought 10 houses. So
Jeez.
10 investment properties, right? And so if the loan officer knows that that's the goal, then they can pull the levers to get you to where like it's just push, pull, click, click. It makes it so that you can execute on it. And I'll also be the first one if there's a house that you want to buy, that you're an investor and you're saying, this is what I want to buy. And that, like, I like to have a conversation with you and understand what your buy strategy is. Just have a buy strategy. What do you like? Duplexes? Do you like single families? Do you like commercial? Do you like whatever it is? Do you want to stay in like an area or whatever? But I've had customers where they've brought me a house and like we've talked about, this is your defined box of what you're investing in. And then we put the house in, and where investors are successful is they put the house in. Does it fit their box? Yes. Then buy it. No. Go get another one. Right? Yeah. Pass on it. That's what I like investors is they're not emotional. They look at it that way and they just make business decisions. But I do get sometimes where an investor's emotional and gets attached to the house, but it's not in their box. And I'm like, that is not the right house. Like, I'll try to kick the house out of their box, right? And say,
then it's almost like you're a business partner with them.
I
mean,
think,
and you are.
I mean, after 10 houses, you probably are to some extent.
I mean, yeah.
No, I do think that's where mortgage is. Like, yes, I'm not sharing in the financial, like we're not literally 50-50 partners on it, but I do feel like that's my role is I want to help you. And as a strategist, as a loan officer, I want to help you get wherever you're going. And I also want to bring up things that you're not seeing that maybe we should just have a conversation about. And then I should tell you, like, you're not thinking about it. What happens this. I'm a big proponent of looking from the loans as kind of like a worst case scenario and then pushing to create the best case scenario. Right.
Yeah. And I like how you kind of off of that, you were mentioning earlier that about the books, you read one about hospitality and sort of in the restaurant world, and yet you're still able to apply that. And you're just talking about how, you're building these relationships with people. I think that falls into really any aspect of the business world. It's all about relationships, no matter what business you're in. Right.
Mm-hmm.
And it will always come back to be a benefit if you are somebody who values relationships and cares to build those relationships. And I imagine in more ways than even just like, I don't know, completing a loan, or for us, maybe, bringing in more customers. Like there's some really cool, my uncle, for instance, has built a really good relationship with his Nicholas foods vendor, and he would get jazz tickets all the time from the food vendor just because they had built a really good relationship together.
Yeah.
And that went beyond just, I buy food from you and you deliver it to me.
Yeah. I mean, one of my best customers, we just we went and hung out. You know, it's not just about the loans. That's where I want to get to with my clients, and a bulk of them are that. Like, we do things outside of just residential mortgage. I went to dinner with one of my real estate agents last night, and her husband and Shauna, and we had a great time. You know, I just feel like that's the key that we should all be working towards, is just, you know, be in business for the customer, and everything else will take care of itself.
So off of that, Tim, where can people find you? How can they look you up?
Well, I work for Bank of Utah. I love Bank of Utah. It's a community bank. It just has the right feel. You know, it's got a lot of different loan programs available to you. Just, they do things the right way. So, you know, my emails, just, we can share that with you in the blog. And eventually I am working on, I'm working on a blog right now that I'm going to be putting out soon. I don't have it set up yet, but it's going to be called Be Better Buyers. And it's really built around what we're talking about: pausing, getting information, reflecting, having a plan, and then executing. And then once you execute, guess what? We're going to do it. Like, we should just continually go through that process. So, like,
rinse and repeat.
Yep. Mm-hmm. Rinse and repeat. And so awesome. I hope to get that out in the next month or two. But I would love to share that at some point.
Be Better Buyers.
Be Better Buyers. Yep.
Okay.
That's what it's going to be.
Awesome.
And it's not going to be about loans. Like, it's not going to be about FHA and VA and conventional and interest rates. And it's not going to be about that kind of stuff. It's going to be more about goals, and more about being prepared and doing things the right way.
Doing things with intention.
Yeah,
I think is what you were saying earlier.
Being on purpose.
Yeah. Don't move money around when you're buying a house. Like, you know, that's a bad move money from this checking account to this savings account, or vice versa. Like, stop. Just leave it alone for a minute and let me do it. So yeah, it'll be very intentional and very open to conversation and just learning. Awesome. It's education is what it's really going to be about, and just putting yourself in the best spot to buy a house, or to refinance, or to build wealth, or like whatever. It's going to be good.
Sweet. Well, Tim Roberts, everybody, thank you so much for joining us today.
Yeah, thank you. It's
on
been
our
fun
podcast. Yeah.
Simple conversation.
Oh yeah. Easy peasy.